you heard of the rule of 72? Hello, I'm Bill Syrios. If you want to maximize your investment returns, live and die by this rule. Please note, this is the second video we have produced for private lenders. If you haven't seen part one, it's on YouTube, and I'd encourage you to watch it. Whatever your interest rate is, divide 72 by that number, and you will find out how long it will take you to double your money. So, if your interest rate is 1%, which is more than many people are making today, then divide 72 by 1. Yes, it will take you 72 years to double your money. And there's that thing about inflation. Yeah, sorry about that. Now, if you can make 9%, you can double your money in 8 years. Not bad. Not bad at all. This kind of interest rate, 9%, is only good, however, if it involves a low-risk investment opportunity. And I know it's a surprise, but I actually have one for you. It involves two of my sons, Andrew and Philip. I've been investing in real estate for over 33 years now. 23 years ago, I started Stewardship Properties in Eugene, Oregon. From one house in 1989, our company grew to over 500 houses and apartment units, most of which are around the University of Oregon, where these two middle sons of mine graduated as business majors. But the campus rental market has been discovered, and the prices, in my opinion, are just too high compared to the rents going forward. To find a low-risk, high-return alternative to campus rentals, we searched around and settled on Kansas City, Missouri. Why Kansas City, Missouri?
Well, we have a lot of family nearby in Kansas. However, the main reason we're out in Kansas City is the numbers.
This is the neighborhood of the house we're buying on 75th Street. Very, very pleasant neighborhood. Next to kind of a busy street, but those are the houses close to it. This is the house itself. It was a HUD foreclosure property, and I think it was listed for $43,000. It's actually fairly large. We put an offer in at $23,000, and back and forth really held our ground, and they ended up selling it to us for $26,000, which was a heck of a deal. It's actually got a nice garage and shop in the back. The house needs some work on it, probably $6,000 to $7,000 worth of work, new carpet, paint, new HVAC, or at least AC. It's got 3 bedrooms, 2 baths. Downstairs you'll see there's a large family room, and we feel like it's just a great value when we have $30,000 altogether in on this house, or so, maybe 32.
When you can buy and rehab a house like 75th for $32,000 or so, and then rent it out for $825 a month, the numbers simply work. In fact, they work very well. Kansas City is the major transportation hub south of Chicago and north of Dallas. It has been growing steadily, and its unemployment rate is only about 6.5%. During the real estate run-up in the mid-2000s, the Missouri side of Kansas City saw significant price increases. And then when the recession hit, those prices fell to the floor, and it became one of the worst areas in the entire country for foreclosures. Let's take a case study of 8618 Oxford Avenue. It's a 4-bed, 1.5 bath home with vinyl windows and a 2-car garage. In 2005, Oxford sold for $117,800. Then look what happened. We bought this house as a Fannie Mae foreclosure in September of 2012 for $37,000. Then we put in $19,000 in repairs for a total investment of $56,000.
And after a rehab of this house, we rented it to a young, upwardly mobile couple for $895 a month.
When houses drop in price from $100,000 or so to around $35,000, entire neighborhoods can go into foreclosure. It even affects houses that shouldn't drop that much in price. For example, 9915 Harrison. Even long before the run-up, this house sold for $74,950 in 1997, which was likely its approximate value all the way from the late 80s to the early 2000s. We purchased it from a bank for $28,250 and then put $10,250 in ourselves for a total of $38,500.
And we rented that house for $995 a month.
Since arriving here in January of 2011, we've already seen house prices begin to rise. So you can understand why we believe we are buying these houses at their historic low point. Not only is this an unrepeatable time to be buying such properties, we are getting them for even less than most homeowners and other investors. During 2012, we made 339 offers. We make a lot of low offers, especially to lenders and banks. When we get a property, it's a good deal, and sometimes it's an incredible deal. During 2012, we only got a contract on 1 out of 10 houses we made offers on. So when you take the exceedingly low prices with the exceedingly large number of offers, it all adds up to some great deals coming our way that have a ton of built-in equity from the day we buy them.
Our general strategy is be in the middle of the market. When you purchase in the lower middle and middle, you tend to get the good and great deals. This is the best juncture for strong cash flow, a moderate amount of property management hassle, plus a relatively solid opportunity for appreciation. All this is for naught, however, if you don't contain your expenses, especially in rehabbing the property, and ensure income potential through quality property management.
Nearly every property we buy is vacant and needs some work. We try to look for ones that need $5,000 to $10,000. As much as possible, we want to take a dated, older house and remake it into a livable, modern home, increasing its rentability and value.
Okay, this is a new acquisition. Andrew, the address here is?
It's 9049 Grand.
Okay, tell us about it.
It's a 3-1 in the Waldo area, which is a pretty desirable area, a little bit older, but a nice area. And it's got all vinyl windows. It actually needs very little inside. The only issue is they're using a cadet heater to heat the entire house, which is just not going to do the trick. So we need to put a furnace in, and we need to put some ductwork up in the attic, which won't be particularly difficult. But there's not a lot of other else to do other than some touch-up and knick-knack type of things.
What do you think that'll cost to put in a new ducting system?
$2,500 for the furnace and AC in the A coil, and then
Grand, 15.
Grand, yeah, maybe 1,500 for all the duct work and whatnot, plus the registers, and it's probably 4,000, give or take. Probably a little, put a little bit more just in case. This is maybe blinds, maybe a good cleaning.
Rehabs and acquisitions is exciting and flashy, but a good deal isn't worth anything if you can't retain and extract value from the asset. The most underrated but important aspect of a buy and hold strategy is property management and maintenance. In Kansas City, we own our office and rent a shop and garage just down the street, from which we coordinate everything from leasing properties to fixing toilets. We also use aggressive marketing and branding strategies to give ourselves an advantage in the marketplace. Now, our company name is Stewardship Properties. It's a name I really love because it reminds me of how we need to take care of what has been entrusted to us. But in Kansas City, our property management company is known as 333 Rent. Our easy to remember phone number and our website, 333rent.com.
So we have solid systems in place. Eventually, we will refinance private money into lower interest bank loans. But we have no problem paying 9% interest, and here's why. Traditionally, it's been thought that a property should rent for 1% of its value. So a $100,000 property should rent for $1,000 a month. But you can't get that kind of rent-to-cost value in many areas of the country. Take a home we rent in Eugene at 303 Myra Court. It's worth about $135,000, but only rents for $995 a month. That is a rent-to-cost ratio of not 1%, but 0.73%.
By comparison, you can look at 5401 East 100th Street in Kansas City. We're all into that for $44,000. It rents for $895 a month, which is a 2.03% rent-to-cost ratio. Or you could look at a duplex we have at 1424 North 63rd Terrace. That's in Kansas City, Kansas. We're all into that for $56,000. It rents for $595 a side, so $1,190 total. That's a 2.13% rent to cost ratio. And then every once in a while you'll get one like 10803 Bennington Avenue in Kansas City, Missouri. We're all into that for $23,000. It rents for $750 a month, which is a 3.26% rent to cost ratio.
In 3 years, if you had no expenses, you would own Bennington free and clear. That's pretty incredible.
What rate of return are you earning on your CDs, stocks, IRAs, and other investments?
Did you know that you can redirect your IRA to investments of your choice, including private lending? Are your investments secured by any collateral? Are you certain of what your investments will earn you each month?
We currently have 68 private loans for over $5 million.
We are flexible with our lending period, with most loans going between 1 and 4 years.
To receive 9% interest with a note, personal guarantee, and first deed of trust as collateral, you don't have to go to Kansas City. We're already there.
Remember the rule of 72. At 9% interest, it will take only 8 years to double your money. When do you want to start?
On behalf of Philip and Andrew and myself, thank you.